So today we are going to discuss more about capital structure, and if the time permit, we'll talk about the theories of capital. So as we discussed the three phases, that is a combination of capital. The result of capital structure is a response of different people who are involved in capital decision. The optimum capital is not exactly any capital which I can say this is a great, this is a good, or this is a bad. It is not exactly any capital which I can say this is a good, this is a bad. The optimity and the returns, they match each other. It's in that combination of own and borrowed where I have maximum wealth maximization. So let me explain the concept. Wealth maximization. Suppose I have 100 rupees and I use this 100 rupees and give the dividend of 100. After 5 years or after 1 year or after 1 month, if the company want to expand, they will take it loan. Then I have the interest to pay as additional cost. So companies normally out of the profit, they divide it some part of dividend and some part as return earned. So if I start keeping the reserves like capital reserve or I have general reserve or other reserves. So these are certain reserves which if I start maintaining, this reserve is used for capital structure changes. This is used for some others and the other reserves I can use. So now if I have one plant which is producing 100 as income, I can keep some profit retain and I can start one more plant which gives me 100 return. From this also follow the pattern. I go with the third plant and so forth and so on. Then will go with the fourth plant. So my profit is increasing. So when instead of one line of input, the multiple line of inputs are created, my flow of income is higher. And this is called as wealth maximization. So in case of wealth maximization, I'm trying to understand how the flow of money is more accurately, more deliberately created. Instead of just thinking of what I can use today, I can plan about future and increase the base or source of income, and that is wealth maximization. So the optimum capital is that structure where the wealth is maximized, the gain is maximized, and we can talk about the different avenues or source of income. So if I want to have optimum capital structure, I need to have wealth maximization and I need to have the combination of debt and own capital, which will create productivity. These are the features of, or we can say qualities of good capital structure. Please just go through this. So let's discuss about the qualities in short. My capital structure should be simple, precise, and clear. It should not involve the multiple source or multiple obligations because again the record keeping, the transactions and deadlines will be there. The charge of capital should be simple and clear, and it should not hamper my operations or liquidity or profitability. It should result in wealth creation rather than creating the only pool of money. Because at the end of a period, this pool of money is required to be returned, or I need to justify the money is to be given back. So in this case, when the money has to be given back, I need to understand, I need to focus, and I need to regulate that purpose of this money and application of this money. So a good capital structure should be meeting with the maximum profits. It should be able to control. It should be able to regulate. It should be able to divert. So if I can control, regulate, divert, and understand the flexible capital, which is wealth maximizing, meeting with legal, having low risk, then it is called as a good capital structure. Please read the all qualities. They are self-explanatory, so I'm not giving more time for this explanation. So let's move on. The factors which affect the capital structure. The first factor is size of business. When the business is small, the capital requirements are small. Suppose I have only startup company, the amount of money which I require is generally low. If my company is large, it is multinational company, then it involves complex and larger size of capital structure. If I have a consistent reciprocate records of earning profits, then my all investors are happy and delighted about same. And in that, the earnings has a greater advantage. So in this regards, the capital structure will be a greater value to our side. So when we're dealing with any structure of capital, we need to understand how much, where, and when the capital is required. For example, if the business is just operating on local level, then in that case, the amount of capital required is very less. But if the operations are on multi-state, multi-locations, the amount of capital is more. So the first thing about capital is how much I have, how much I can, and where I can. If suppose the company is well reputed, well advanced, in that case, the capital is normally more, whereas the company is not reputed, having bad culture, bad stability, and less credibility, the capital is minimized or complex. When there is a risk and less crediting, the cost of capital increases. When the business is such a nature that there is no competition, then the degree of competition will affect on cost of capital and the profitability the business can earn. So talking about the stage of cycle, that is its initial cycle, growth, maturity. We can talk about two cycles, one cycle of business and second is life cycle. So in life cycle, if suppose we have the first phase as research, then we have introduction where the company starts, then we have something called as growth, then we have maturity, and then we have a decline stage. So in the initial period, the capital is less. In the introduction and growth period, because company is progressing, the amount of capital is much more. Whereas in latter part of growth or latter part of maturity, normally there is little changes in capital because company has already having the money which they require. So here the need for money is very limited and the amount of contribution is less. Whereas when it goes in decline stage, at this last stage, the people will start withdrawing the money from business. And in this stage, the amount of capital will be less. So if I'm very good company and I continue with the growth or I extend the PLC, I'm doing good. But if I'm have limited scope, then in that case, even though I'm a good reputation, credit rating, and performing, but my product is no more demanded, then people will start affecting the capital. They will start withdrawing their money. They start withdrawing their investment. Then we have another cycle, which I said as inflation cycle. So we have something called inflation, stagnance, deflation, and recession. So this is stagnant, this is deflation. Deflation is going down, stagnant is steady, inflation is moving up, and recession is a slow death. So in inflation stage, the companies are having boom. They are progressing very high. They are growing very high. So when the companies are progressing very high, the growth rate is high. So in that case, the companies has advantage. The companies has benefit to earn more. So when their earning capacity is more, they are doing more production. The degree of competition is less. In this period, the capital structure is normally a growing season. In stagnation, the company is at peak. It can be a market leader or it can have major share in market. At this situation, the company is deciding about buyback of shares, bonus shares, right shares, and so on. So at stagnation stage, the capital structure restructuring is more because I have funds and I have enough time to adjust it. So based on this, the major changes happens at the stagnation. Now, when the deflation happens, deflation is exactly opposite to inflation, where instead of growth, I start making losses. So when an organization start making a loss, ultimately it will reduce the borrowed capital. So the persons who have invested in company, they will start the withdrawals. They will ensure the amounts which are available or possible, they are being withdrawn, they are being reduced. And considering this all scenario, the profit and credit rating also start falling. When the profit and credit rating start falling down, the scenario of capital structure changes and it affects the number of people associated and the capital become less and less. So the product life cycle and the stages of business cycle certainly affects the capital structure. The attitude, I need not require to say, if the business is friendly with the investors, they have disclosure policies, they have good norms, they are paying dividends, they are timely disclosing the financial statements, they are making trendy growth, then the investors has a rock solid confidence in that company. For example, if I compare the Tata Motors and Philips, the Tata Motors has a reputation of investor protection. If I compare Tata with the Reliance has a reputation of high returns. So even I'm a patriotic person, I can shift to the Reliance if I want a profit. If I want a long-term growth, I can shift to the company which has attitude to protect investors and contribute to a long-term growth. So considering the vision, mission, and strategic operations of any company, the structure of capital can change. If the company has a risky decisions and sharp growth, then these risk profiling companies has sharpened changes in capital structure. They can be higher, they can be lower, or they can be average, depend on the response to the stimulation of investors. In some businesses, even though possibilities are there, the most of the time they go on dividend declarations. But if the amount of dividend declared they are compared to less to the market, so in such companies, the investments in capital will be limited. In such case, the companies have less people who like to invest, and their capital structure is more of own capital and less of borrowed capital. If the company is listed and being traded shares, then the capital structure has growth and potential confidence in the same. So in this type of companies where the potential growth and trade is observed, the people will has enough confidence based on profit whether to buy the shares or whether to sell the shares. So again, in relation to the trading option or in relation to the coverage of interest. Now here interest coverage means suppose I have taken a loan of 1 lakh rupees with 10% interest and if I investing in a company which give me 11%, so indirectly I'm getting something more than what I expected. But if the returns are less than what I expect. In that case, the interest coverage ratio will be poor and I'm not investing in that company. So if I take look up from factor 1 to factor 11, all these factors are situational. If I'm doing good, my capital structure will be good. If I'm doing injustice, fraud, cheating, or malpractices, have less capital. Whereas there is a fluctuations in all degrees in competition, decision making, and others, then my capital structure has higher cost of borrowing and they have a sharp change or shift in moment. Please read these factors. If any doubt, please ask me in chat box or you can unmute. So I hope there is no doubt. So let's move on. This is a chart which talks about how the capital structure is impacted. So let's discuss in detail. We have always two decisions in any company. One is investment and second is a financing. The investment decision talks about the growth in fixed asset, growth in long-term or short-term investments, where company books is financial obligations, understanding the futures. Whereas the financing decisions are those decisions where I'm only following the income and expenditure pattern and try to adjust the gains or expenses. So in investment decisions, I'll take care of long-term growth decisions like fixed asset or like long-term investments or something. Whereas in financing decisions, I'll take call about daily routine expenses. In capital structure decisions, I have to take call about my current capital, its combination, its buyback, bonus shares, right shares, etc. So these three decisions will impact on two levels. Either I will give the dividend or I will not give the dividend. In case I give the dividend, I will be giving dividend as bonus shares, right shares, or debentures or cash. So if I pay the dividend, I'm a good company. If I do not pay the dividend, I'm a bad company. When the bonus shares are issued, the profit is retained and I have advantage to use this retained profit for a long term. When I issue the right shares, I get something premium and again my capital appreciation is there and this is advantage to myself. When I issue the debentures, out of dividend, then I have a reserve for a certain period which I can capitalize for my growth. But when I pay the dividend in cash, it's a short-term obligations and company is not interested in wealth maximization. Suppose if I pay dividend, I'm a good company. If I'm not paying dividend, it is considered that company is not taking care of their investors. So in that case, the combination of debt and equity will change. If dividend is there, I have higher debt. If dividend is missing, then I may lose debt. I need to go with the equity combination only. So if I have higher equity combinations, it will affect my earning per share. But if I combination of equity plus debt, it will create a risk on company to honor the payments. And similarly, it will affect the cost of capital and value of firm. So the overall investment, finance and capital decision, what I take or what stage it influenced me to take that kind of decision will certainly make an impact, will certainly make a call regarding how much is my capital, what is source of my capital, and how much the business is generating income for my business. Now, these are the four main theories as per your syllabus, which we are dealing about. So, I'll give some few seconds. If you can understand the difference between all these theories, I'm not expecting third one, Moodle Miller. The difference between first, second, and third, you can just post in chat box. Let's guess how much you can understand finance. I don't think there is a reply, so let me continue myself itself. The first approach is net income approach. So here, importance is given to my net income. In second approach, the importance is given to net operating income. So here, my business activities and gain is important. Here, my profit or my returns is important. In traditional approach, the decision is based on more risk and profit combination. So these are the certain theories of capital structure. Now, when I talk about Pudal Miller, he has the three different propositions: proposition one, two, and three. He talks about only equity, combination of debt plus equity, and the combination based on the percentage of risk which we are taking. So, in short, the capital structure theories are being largely affected by payout and by dividend. Let's move on. So, in economics, we got micro and macro. The two types of research that are there. One is a traditional, what we call as a classical economics, neoclassical economics, and modern economics. Same classification we have in finance. There are some classical financial scientists which believes only two things are moving and other thing constant. Some neoclassical theorists which believes The group of things are moving and group of things are constant. And there are some modern financialists which believes everything is moving and nothing is limited. So similarly, these all theories has certain assumptions which are common. So just go through the assumptions. I'll take a pause of few seconds, then I'll start explanation. So let's begin. I think the reading part is done. Now, when the question is about the theories of capital structure, please remember these all are common assumptions which you can use for the theory. The most important assumption is there is no corporate tax. So the tax is not there, and the legalities of tax is not going to make any effect or any decision about capital structure. Then there are only two sources of funds, that is debt and equity. So only two types of capital are there. One is a borrowed capital and one is a self capital. Any other combinations or refinancing is strictly not considered in all these things. The each company under these theories of capital structure are assumed they are paying their amount, which is called dividend. So all these companies are paying dividend. They are not postponing, cancelling, or changing decision of payment of dividend. The investors which are investing in these companies, they have the knowledge about their decision, and these decisions about investment is constant. Only the impact by dividend and other factors which are mentioned in the theory. Otherwise, the decision is remain constant. The total value of finance is same. It does not change. The profits is constant and they are expected to grow. There is nothing loss situation expected. The risk factors is constant in all businesses, and the all business total assets of company are not going to change. So what are common assumptions? First, no tax, no change in financial decisions, no change in dividend payment condition, no change in assets, and no change in risk regarding business. So these are the common nine assumptions of four theories. Please once again read these assumptions. These assumptions are very crucial because these are common, and when you write in examination, 100% there will be the numerical or sorry theory on capital structure. So please read this once again. So when you write any answer to theory, you can blindly mention these assumptions and you can the other assumptions are very limited. So let's move on. Let's talk about first theory, that is net income approach theory. The net income approach theory talks about the productivity, the gains, and other things in the business. Apart from this, they are considered all other factors are held constant and there is no subsequent change in the same. So just read the introduction part. I'll start explanation. So let's continue discussion. I hope reading part is over. The David Durand has proposed the net income approach. As per his approach, the valuation of firm is depend on change in cost of capital. So what he believes, the change happens to be positive, change happens to be negative in structure of capital. How much I have borrowed capital, how much my own capital. These all two things will make an impact over my profitability and my other assumptions. And considering this, the change in the capital will impact my cost as well. So how much change is there? That will change my cost of capital and that will change the structure of capital. His assumption, like I said, the cost of corporate tax is zero. There is no change in cost of because I'm changing my debt and equity combination. So let's see what he has proposed. In case of my debt is increased, then cost of capital will go on declining. That is, my market share will increase and value of firm will increase. Because when I have the outside capital, more participation and more money will come in the market. And this will help me the cost of debt. So whether I should invest more in capital or whether I should invest more in debt, that decision I require to take in this fall. So in net income approach, I have indirectly need to ascertain how much and where I will invest and I will progress to relocate my value. So in this approach, the cost of debt is considered very crucial for capital decision. If the cost of debt is declined, then my cost of capital will increase. Now here K0 indicates my equity. When I have combination of debt plus I have combination of equity, if the debt is rising, the equity will fall and the cost of capital will fall. When the more people will invest, I already has equity shareholders. When I increase my number of debt people, the market value of firm will increase. In reverse, when the debt is declined, I require more money to introduce as my equity capital, and the cost of equity will rise. That will increase my cost of capital. Since the people are start giving up my debts and they are no more interested in debt regarding my firm, so in this nature of companies, the market value will decline and the firm's overall stability will also be decline. So I'm going to share the one more PPT to explain this concept more in detail. I hope the PPT is visible. If any issue, please update. So in net income approach, the firms are unlocking their capital structure value by using the combination of debt plus equity. So what are the assumptions? All assumptions same, no change in tax, no government intervention, only the change in debt and equity. So this approach is proposed by David Durant and also known as fixed K theory. This theory suggests the increase in firm's value as the debt finance increases and decrease in debt value as the debt capital reduces. So as per this, let me introduce and let you understand. Suppose I started my company as a single person E. I put in all equity in the firm and I invested 1,000 rupees. So if I'm doing myself business, then people are having less debt. So here, in case no debt is there, then my value of firm will decline. In reverse, suppose I started the debentures or borrowed capital, that is KD of 5,000, it will increase my the value of firm because more money is coming in and more people are associated. So now instead of me only, more people if they're coming in company and paying, the value of firm will increase. So simple concept in this net income approach, that if the number of debt is increasing, the value of firm is increasing. So increase in borrowed capital will increase your value. That's it. Let's explore further. They have assumptions like no change in risk, everything is constant, and no taxes are there. This is the core formula for net income approach. It says value of firm is combination of market value of equity and market value of debt. So overall cost of capital is net operating income divided by this V. So let me illustrate. Okay, let me start the whiteboard if I can. No, I cannot start the whiteboard. So what I'll do is I'll just share my Excel and I will illustrate the things. So this is a basic formula which I need to remember is value of firm is equal to, I'll just zoom it for reading purpose. Value of firm is equal to cost of debt plus cost of equity and the capital structure, or we can say cost of capital is equal to, so cost of capital K is equal to net operating income, which is divided by this V. So we'll take the propositions. First, I have a cost, then, okay, I forget to share the Excel. I'll share it. Now, I think it is visible. Yes. So I written down the formula. Now I have cost, I have debt. Let's assume that my net operating, sorry, net operating income is 1000. Will not change this. So I have option 1, option 2, and option 3. So in first case, I have the cost of equity and cost of debt. So here I'm talking about the market price of equity. So I'll just write down in bracket market price, and for debt, I'm writing again market price. So as per this net income approach, suppose the value of equity is 100 and value of debt is 0. Now my price in equity is remain 100, but if the market price of debt which I'm having is suppose 300, the here the price of my shares reduced to 50 and they increase here to 400. Sorry, here it is 350. Okay, I'm sorry, 350. Here it should be 400 because there is no change in capital structure. And here my debt will be 50. So these are three combinations. The all combinations is that I have debt and this equity. Suppose the market price is of equity is 10 rupees and market price of debt is 15 rupees. So in this combination, I have the price of S is equal to 400 into the equity, and this will become, so into this, so value of firm is 4000. Now in second case, it will be equal to this into 10 plus 300 into 15. So value will be 5500. In third case, it is value of firm will be 350 into 10 plus 50 into, so it is 4250. So we can see when the debt is more, the value of firm will be more. It has more appreciation. When the debt is less or it is negligible, the value of firm is negligible. So if I want to have the returns, then I'll take this 1000 instead of this 1000 as in 10,000. So here, if I just find out the 10,000 divided by 4,000, my answer is 2.5. Here, 10,000 divided by this, my answer is 1.8. Here, if I find out 10,000 divided by 4250, my answer is 2.35. So you can see that when the value of firm is increased, the cost of equity is declined. So as per this theory, my dividend or my debt should be more. My net operating income, it is not change. My cost of price of debt on equity, it will not change. If I take the fourth approach, where it is 200 and it is 200, then my answer here will be 200 into 10 plus 200 into 15. It is 5,000. And here my answer will be 10,000 divided by 5,000. It is 2. So these combinations which I'm going to make will certainly affect my value. I get a combination of this as highest and combination of this as highest. But if I only take equity or only debt, my combinations are less. So comparatively, this is lowest cost of capital, and I can consider this as optimum capital structure. I guess I'm able to clear it a little bit. We can discuss more in next session. Before log out from this session, please remember working capital management is an essential subject of NPTEL for all my mentees. At 10:30, I'm going to check your exam registration details. So please check your details. If you're not still registered, before 10 o'clock, you should pay the examination fees of the course. The detail already being shared to you via WhatsApp and in your group. Please check the details and complete a registration for working capital as your subject of NPTEL for my mentees. Now you can log out from the meeting and join the next session.